There's a question that keeps more retirees awake at night than almost any other, and it sounds so simple that people are almost embarrassed to ask it. You've got some money. Maybe it's a chunk of savings you've built up. Maybe it's an inheritance that just landed. Maybe it's the proceeds from selling something. And you've got a mortgage. And the question is, should you take that cash and wipe out the mortgage once and for all, or should you hold on to the cash and keep making the monthly payment? Now, here's why this question is so maddening. Ask 10 people and you'll get 10 answers, all delivered with total confidence. Your brother-in-law says never carry debt into retirement. Pay it off. Sleep like a baby. Your financial advisor says, don't you dare. Keep that money invested, you'll come out way ahead. And they can't both be right, except that, in a way, they both are. Because the correct answer genuinely flips depending on one specific number. Below that number, keeping the cash is clearly smarter. Above it, paying off the mortgage wins. And most people have never been told what that number is, so they're just guessing or following whoever sounded most sure. So today, I'm going to give you that number. I'm going to show you exactly how to run the comparison for your own situation in about 2 minutes on the back of an envelope. Then I'm going to walk you through a whole set of real-world case scenarios. The person with the 3% pandemic mortgage, the person with a 7% loan they took out recently, the couple down to their last few years of payments, the person deciding whether to raid their retirement account to do it, so you can find the one that looks like your life and know exactly what to do. And I'll give you the tips and the traps, including a middle path option that a lot of people don't know exists, and that turns out to be the perfect answer for many of you. But I want to promise you something up front because this topic is full of people selling one answer. I'm not on either team here. There is no universally correct answer to this question. Anyone who tells you always pay it off or never pay it off is selling a slogan, not advice. The right answer depends on your number, your situation, and honestly, your personality. My job is to hand you the framework so you can find your own answer with clear eyes. Let's do it. Let me give you a couple to follow. Call them Tom and Sandra, both 68, recently retired. They've got about $180,000 in a savings account earning a little interest, and they owe about $180,000 on their house. It's almost a perfect match, which is why they keep staring at it. Every month they write that mortgage check, they wonder if they're being foolish for not just ending it. Let's figure out their answer, and yours, together. All right, here's the one number and here's the whole framework in a single sentence. So listen closely. Compare your mortgage interest rate to what your cash can safely earn after taxes. Whichever is higher, wins. That's it. That's the entire decision boiled down. Let me unpack it, because every word matters. On one side, you have your mortgage rate. This is guaranteed. If your mortgage charges you 6.5%, then every dollar you use to pay it off earns you a guaranteed 6.5% return, because that's 6.5% of interest you no longer have to pay. And here's a subtle but crucial point. That return is completely risk-free and tax-free. There is no investment on earth that can promise you a guaranteed tax-free 6.5%. Paying off a 6.5% mortgage is exactly that. So think of your mortgage rate as a guaranteed tax-free return you can buy by paying it off. On the other side, you have what your cash can safely earn. Right now, in 2026, safe places for cash, high-yield savings accounts, CDs, treasury bills, are paying somewhere around 4%. But here's the catch that trips almost everyone up. That 4% is taxable. You pay income tax on the interest. So if you're in a typical retiree tax bracket, say 12 or 22%, that 4% isn't really 4% to you. After tax, you actually keep somewhere between 3 and 3.5%. Now put the two side by side, which is the whole game. On one side, paying off the mortgage gives Tom and Sandra a guaranteed tax-free 6.5%. On the other side, keeping the cash in the bank earns them about 3.25% after tax. 6.5 versus 3.25. It's not even close. In their case, paying off the mortgage is the mathematically obvious winner. They're currently earning 3.25 to keep money that's costing them 6.5. Every month they keep that cash in the bank instead of paying the mortgage. They're losing the difference. So that's the number, your mortgage rate versus your after-tax safe yield. And now you can see exactly why the answer flips. Because let's rewind a few years. Imagine Tom and Sandra's mortgage wasn't 6.5%. Imagine it was 3%. One of those pandemic-era loans that millions of people locked in around 2020 and 2021. Now run the same comparison. Paying off a 3% mortgage gives them a guaranteed 3%, but their cash in the bank is earning 4%, and even after tax, that's still around 3.25%. Suddenly, the cash is winning. Now it would be foolish to pay off that mortgage because their money earns more sitting safely in the bank than the mortgage is costing them. Same couple, same house, same cash. Completely opposite answer. And the only thing that changed was that one number, the mortgage rate crossing over the after-tax yield on safe cash. Let me put a finer point on the crossover, because it's worth being precise. The true break-even isn't your mortgage rate versus 4%, it's your mortgage rate versus 4% minus your taxes. So for a retiree in the 12% bracket, safe cash at 4% really keeps about 3.5%. That means any mortgage above roughly 3.5% tips toward payoff, and any mortgage below it tips toward keeping the cash. For someone in the 22% bracket, safe cash keeps only about 3.1%. So the crossover sits even lower, meaning even more mortgages tip toward payoff. Here's the shortcut. Take your safe yield, knock off your tax bracket, and that's your line. Today, for most retirees, that line lands somewhere between 3 and 3.5%. If your mortgage rate starts with a 3, keep the cash. If it starts with a 5, 6, or 7, lean hard toward payoff. The ones in the low 4s are the genuine coin flips where the other factors decide. That is the flip. That is the whole video in one idea. When your mortgage rate is higher than what your cash safely earns after tax, lean toward paying it off. When your mortgage rate is lower than what your cash safely earns after tax, lean toward keeping the cash. Everything else we talk about today is just refining that core comparison for your specific life. Now, before we get to the scenarios, I have to kill a zombie. A piece of advice that will not die and that costs people money. You've heard it. Don't pay off your mortgage, you'll lose the tax deduction. I need you to hear this clearly, because for the overwhelming majority of retirees, that advice is now flat wrong. Here's why. The mortgage interest deduction only helps you if you itemize your deductions. And to itemize, your deductions have to add up to more than the standard deduction. Well, the standard deduction has gotten enormous, especially for seniors. In 2026, a married couple where both are over 65 gets a standard deduction of around $47,000, once you count the extra senior amounts and the new senior bonus. $47,000. To beat that by itemizing, you'd need mortgage interest plus everything else to exceed $47,000. And most retirees, especially those far along in their mortgage paying mostly principal, don't come anywhere close. The result? Around 90% of taxpayers now take the standard deduction. Only about 1 in 10 itemizes. So for roughly 9 out of 10 retirees, the mortgage interest deduction is worth exactly $0, because they're taking the standard deduction anyway. Please do not keep a mortgage for a tax deduction you're not even using. Check your last tax return. If you took the standard deduction, that argument does not apply to you. Full stop. Okay, let's find your situation. Here come the scenarios. Scenario 1. The pandemic locker. This is millions of you. You have a mortgage at 3%, maybe 3.5%, that you either bought or refinanced into back in 2020 or 2021. Let's say Tom and Sandra had won. $80,000 left at 3.1%. 12 years to go. Run the number. Their mortgage costs 3.1%. Their cash safely earns around 4%, which is roughly 3.25% after tax. The cash is winning, even if only by a little. So the math says, keep the cash. Do not pay off that mortgage. That 3% loan is one of the most valuable financial assets you own. It's cheap money, locked in, that you can never get again. Keep it, keep your cash liquid and earning, and honestly, enjoy the fact that inflation is quietly eating away at a debt that barely costs you anything. If you have a pandemic-era mortgage under about 4%, the math is clear. Keep it. This is the one scenario where paying it off is usually the wrong move. Scenario 2, the recent buyer. You bought or refinanced recently, and your rate is up around 6.5%, maybe 7%. Say it's $180,000 at 6.75%, with a long way to go. Now the number flips hard. That mortgage is costing you 6.75%, guaranteed. Your cash earns about 3.25 after tax. This isn't close. The mortgage is costing you more than double what your safe cash earns. If you have the money sitting in savings, paying this down is one of the best guaranteed risk-free returns available to you anywhere. And look at the stakes. On that $180,000 balance, if they keep it the full term, they'll pay roughly $184,000 in interest over the life of the loan, more than the house balance itself. Every dollar of principal they knock out now saves 6.75 cents a year, forever. For the high-rate mortgage, the case for paying off is powerful. Scenario 3. The home stretch. You're near the end of your mortgage. Just a few years left. Say $40,000. 6 years to go. Here's the counterintuitive twist most people don't realize. When you're near the end of a mortgage, almost all of your payment is going to principal, not interest. The interest is nearly gone, so paying it off early saves you surprisingly little in interest. In this example, maybe $9,000 total over those last 6 years. The math benefit is small, which means this decision becomes much less about money and much more about how you feel. If wiping out that last little balance and owning your home free and clear would bring you real peace, and you can do it without draining your safety cushion, go ahead. The financial downside is tiny. But don't raid your emergency fund to save $9,000 over 6 years. Near the finish line, do what lets you sleep well. The numbers barely care either way. Scenario 4, and this one is critical, because it's where people do real damage. Paying off the mortgage by raiding a traditional retirement account. Say you don't have the cash sitting in savings, your money is in a traditional IRA or 401k, and you're thinking of pulling out a big chunk to kill the mortgage. Stop. This changes everything. Because of taxes, every dollar you pull out of a traditional IRA counts as taxable income. So to pay off, say, a $100,000 mortgage, you might have to withdraw $130,000 or more, because you owe income tax on the withdrawal. Worse, a big withdrawal like that can push you into a higher tax bracket, cause more of your Social Security to be taxed, and even spike your Medicare premiums 2 years later through the surcharge called IRMAA. You could easily pay $20,000, $30,000 in taxes and penalties of various kinds just for the privilege of paying off the house. That extra tax cost usually swamps any interest you'd save. So the rule here is paying off a mortgage with already taxed cash from a savings account is one calculation, but paying it off by draining a big taxable retirement withdrawal in a single year is often a bad idea, even at a high mortgage rate. If you want to do it gradually, spreading withdrawals across several years to control the tax hit, and talk to a tax professional first. Scenario 5. House rich, cash poor. This is the person whose entire net worth is basically their home, with very little in savings. If that's you, and you're tempted to throw every spare dollar at the mortgage, be careful. Yes, a paid-off house lowers your monthly expenses, but if all your money is locked in the walls of your house, and then the roof goes, or you have a medical emergency, or the car dies, you have no liquid cash to handle it, and you can't easily get money out of a paid-off house, except by selling it or taking on new debt at today's high rates. For you, liquidity may matter more than being debt-free. Keeping a cash cushion, even while carrying a mortgage, can be the safer play. Don't make yourself rich on paper and broke in the checkbook. Scenario 6. The person who just wants to be done. Maybe your mortgage rate is moderate, the math is close to a wash, and honestly, you're just tired of the debt. You've been paying a mortgage for 30 years, and the idea of owning your home outright, of never having that payment hang over you again, feels like freedom itself. I want to validate this completely, because personal finance is personal. If the math is roughly a tie, say your mortgage is around 4 or 4.5%, close to your after-tax yield, then the tiebreaker is genuinely you. There is real documented value in the peace of mind of a paid-off home. Studies of retiree well-being consistently find that people who own their homes free and clear report lower financial stress. That peace is worth something real, even if a spreadsheet can't price it. So when the numbers are close, it is completely rational to let your heart cast the deciding vote. Just make sure the numbers actually are close first. Don't pay off a 3% mortgage for peace of mind, when keeping it and banking the difference would buy you a lot more peace in the form of cash. Scenario 7. The windfall. This is the situation that sends more people to this question than any other. A lump sum just landed, an inheritance, a life insurance payout, the sale of a business or a second property, a pension buyout. Suddenly there's a big pile of cash and a mortgage, and the pull to just make the debt disappear is enormous because a windfall feels like found money and paying off the house feels responsible. Here's my guidance. Slow down. Do not make this decision in the first emotional weeks, especially if the windfall came from losing someone. Park the money somewhere safe and boring, a high-yield savings account or short treasuries earning that 4% for a few months while you think. Then run the exact same number we've been running, your mortgage rate versus your after-tax safe yield. A windfall doesn't change the math, it just makes the math feel urgent when it isn't. And windfalls are precisely when people skip the emergency cushion step and the tax step and later regret it. Treat that lump sum with the same discipline you'd treat money you earned dollar by dollar over 40 years, because you did earn the right to be careful with it. Scenario 8. The landlord. This one has a genuine twist, so if you own a rental property with a mortgage, pay attention. Unlike your personal home, the mortgage interest on a rental property is deductible. It comes right off your rental income, dollar for dollar, and you don't have to itemize or clear any standard deduction to get it. That deduction is real, and it's valuable, so it lowers the true cost of that mortgage. A 7% rental mortgage, after the deduction, might really only be costing you 5 or 5.5%. So the keep the cash side is stronger for a rental than for your home. Run the same number, but use the after-tax cost of the loan. And for rentals, that deduction genuinely tilts the scale toward keeping the mortgage more often than it would on your own house. Scenario 9. The I'll just wait for rates to drop hoper. A lot of people are sitting on a 6 or 7% mortgage telling themselves, I won't pay it off. I'll just refinance when rates come down, then keep my cash. I understand the instinct, but be careful betting your decision on a forecast. Rates may fall or they may not. The experts have been wrong in both directions for years, and nobody can promise you a refinance window. Here's the clean way to think about it. Paying down your high-rate mortgage today gives you a guaranteed return right now. Waiting to refinance is a gamble on something outside your control. If rates do drop dramatically, wonderful. You refinance, and you're even happier. But don't leave money sitting in a 3% savings account, bleeding the spread every month, on the hope of a refinance that may never come at the rate you're dreaming of. Act on the number in front of you, not the number you wish for. Now let me give you the option that I think is the real hero of this whole topic. Because for a huge number of you, the answer isn't all cash or all payoff. It's the middle. It's the hybrid. Here's the idea. You don't have to choose between throwing every dollar at the mortgage and keeping every dollar in the bank. You can do both, in the right proportion. And here's the smart way to sequence it. First, before you pay one extra dollar toward your mortgage, make sure you have a solid emergency cushion. Most experts suggest a retiree keep something like 1 to 2 years of expenses in safe liquid cash. That comes first, always. Liquidity is safety, and you never want to be house rich and cash poor. Then, with money beyond that cushion, if your mortgage rate is high, you can make a large lump sum payment toward the principal, and here's the trick almost nobody knows about. Then ask your lender to do something called a recast. A mortgage recast means that after you make a big principal payment, the lender recalculates your monthly payment down to reflect the lower balance, while keeping your same low interest rate and payoff date. So you get a permanently lower monthly payment, you save a pile of interest, and you keep your emergency cash, all without refinancing and without giving up your rate. For Tom and Sandra, instead of using their whole $180,000, they might keep $60,000 liquid as their cushion, put $120,000 toward the principal, recast to a much lower payment, and get most of the interest savings while staying safe. That's often the best of both worlds, and recasting typically costs just a couple $100s. So let me pull all of this together into a simple decision path you can actually follow. Step 1. Find your number. What's your mortgage rate and what does your saved cash earn after tax? If your mortgage rate is clearly higher, lean toward paying down. If it's clearly lower, like those pandemic loans, keep your cash. If they're close, go to your gut and your need for security. Step 2. Protect your liquidity no matter what. Keep 1 to 2 years of expenses in safe, accessible cash before you accelerate any payoff. Being debt-free is worthless if you can't handle a surprise. Step 3. Check where the money's coming from. Already taxed savings? The simple math applies. A big traditional retirement withdrawal? Factor in the tax bomb and spread it out or reconsider. Step 4. Consider the hybrid. A partial payoff plus a recast often captures most of the benefit while keeping you safe and flexible. And step 5. Once the math is settled, let your personality break any tie. Peace of mind is a real return. Before I wrap, let me name the 4 mistakes I see people make on this decision, because avoiding them matters as much as the math. Mistake 1. Paying off a cheap pandemic-era mortgage out of a vague sense that debt is bad. That's throwing away one of the best financial assets you'll ever hold. Mistake 2. Draining your emergency cash to become debt-free, and then having no liquidity when life happens. Debt-free and broke is not a good trade. Mistake 3. Emptying a traditional retirement account in a single year and getting hammered by taxes, higher Social Security taxation, and Medicare surcharges. The tax bomb that eats the savings. And mistake 4. Keeping a mortgage purely for a tax deduction you no longer actually use because you take the standard deduction. If you steer around those 4, you'll be ahead of most people who ever face this choice. Now let me be honest and careful with you, the way I always try to be. Everything I've laid out uses current 2026 numbers. Mortgage rates around 6.5%, safe yields around 4%, and those will shift over time, so rerun your own comparison with today's real numbers when you make the decision. And I've kept the keep the cash side deliberately conservative by comparing your mortgage only to safe cash, not to the stock market. If you invested that money instead, the long-run average return of the market has historically been higher than almost any mortgage rate, which is the whole basis for the never pay off, invest instead argument. That argument has real merit over long periods, but I built today around safe cash on purpose, because you're retired, your time horizon is shorter, and a guaranteed return you can count on is worth a great deal more at 70 than a probable return that might not show up until you're 85. Guaranteed and tax-free is a very high bar, and that's why, at today's rates, the payoff side wins so many of these cases. This is also a good question to take to a fee-only financial planner or a tax professional, someone who charges for their time and doesn't earn a commission on what you decide, especially if a retirement account withdrawal is involved, because the tax interactions are where the real money is won or lost. And since we're talking about safety, cash, debt, and how to protect your retirement money, this is also a good place to remember that your mortgage decision is only one part of the bigger picture. Because for a lot of retirees, the real question is not just, should I pay off the house? It's, how do I make sure the money I worked for is protected, diversified, and not all exposed to the same risks? That does not mean you should panic. It does not mean you should rush into anything. And it definitely does not mean gold is some magic solution. But some retirees do choose to diversify a portion of their retirement savings into physical gold through a gold IRA because they want part of their nest egg outside the usual stock and bond system, especially when they're worried about inflation, market volatility, government debt, or the dollar losing purchasing power over time. So if you have money in an old 401k, IRA, or retirement account, and you want to understand whether physical gold belongs anywhere in your retirement plan, I'll leave a link below to a free Gold IRA information guide. It explains how physical gold can be held inside a retirement account, how rollovers work, what the IRS rules are, and what questions to ask before moving any retirement money. So you can use it as a free educational guide and decide for yourself whether a gold IRA makes sense for your situation. You came in with a simple question: pay off the mortgage or keep the cash? And now you have something better than an opinion. You have a method. You know it comes down to one comparison, your mortgage rate against your after-tax safe yield. You know the answer genuinely flips at that crossover point, which is why your confident brother-in-law and your confident advisor could both be right, just about different mortgages. You know the tax deduction argument is dead for 9 out of 10 retirees. You know to protect your cash cushion first, to watch out for the retirement account tax bomb, and that a recast can give you the best of both worlds. So here's what I'd actually like you to do this week. Go find 2 numbers, pull out your mortgage statement, and find your interest rate. Then figure out what your safe cash is really earning after tax. Write them side by side, and in that one comparison, you'll see your answer clearly in your own numbers, not somebody's slogan. Because the goal was never simply to be debt-free, and it was never simply to have a big bank balance. The goal is to arrive at the most secure, most peaceful version of your retirement, with enough guaranteed savings that your money works as hard as you did, and enough cash on hand that life's surprises never frighten you. Get those two numbers, and you'll know exactly which path gets you there, and whichever one it is, you'll walk it on purpose, with your eyes open and your mind at ease.